new market environment. And then we'll take a little bit of time and look specifically at the Allianz Life Pro Plus and how that product really has separated itself in the industry, what gives Allianz an advantage in terms of building cash value with these products, and also in terms of not only building the cash, but accessing that cash value down the road. Now, to begin with, I think we'd all agree we've seen a lot of different changes over the last decade. I'm sure many of you out there would agree that you're not selling the same products that you were 5, 10 years ago, or certainly not selling selling in the same way. We've seen a lot of changes economically when you look at the risk of rising inflation going forward, volatile interest rates, obviously, historic lows, potential for increased taxes, and all that points really to a need for something beyond just your basic death benefit coverage when it comes to life insurance. Consumers, they're living longer, they've changing just general demographics, a need for a more efficient wealth transfer strategy. Distribution shows us that not only carriers like Allianz, but agents such as yourself are looking for new ways to drive your life business. We've had a lot of changes out there with repricing of products like the GUL and shifting the market over to products like current assumption. And so you're looking for new products to do that with. And if we look at the industry, and I'll show you in a moment here, we can see that current assumption, cash value, universal life is the fastest growing segment of the life industry. And really, all these trends together point to a need and an appetite for that cash value life insurance policy. Now, if we go back to 1999, now we just take a quick look across the top here, you'll see the gray and yellow. That's your term and whole life products, more or less unchanged over the last decade or so, comprising about 50% of the life industry. But what's more interesting is if you take a look at the purple there, that was your variable universal life sales back in 1999. And then right below it, your universal life, comprising about 20%. Over this time period we're looking at here from 99 to 2010, we've seen roughly an 80% decrease in VUL sales, while at the same time universal life has more than doubled. Now, what can we really attribute that to? If you take a look here at VUL versus FIUL, this is one of the primary reasons. VUL traditionally has tracked right along with market performance. When the market's been up, you've also seen VUL sales up. Conversely, when the market's been down or volatile, we've seen VUL sales decrease. And obviously here, since 2001, the market has been volatile. People are trending away from products that are going to be tied directly to those market indices. And when you look at FIUL, as it's growing there across the bottom, we see in 2010, for the first time, it actually outsold VUL policies. For those of you who are, maybe more familiar with FIUL, this would come as no surprise. We're seeing VULs being converted over to FIULs every single day. A big part of that is because these VULs that were sold 5, 10, 15 years ago are blowing up. Anytime you see market performance decrease, the cash value on those VULs also decreases. And whenever the cash value goes farther and farther away from that death benefit, you have an increased net amount at risk and increased cost. So your cash is going down, your costs are going up, the policies are not going to last without more premium. So we're seeing a lot of these being converted over to the FIUL product, a product that offers the upside potential to a point, but without the downside risk. And in fact, if you look here beyond 2010, in 2011, FIUL fell just shy of being $1 billion industry on its own, and here in 2012, we don't have all the final fourth quarter numbers in yet, but if you take a look at where we were trending from third quarter, we should be ending up at maybe 1.1 or 1.2 billion in the FIUL space. So looking really at what does that all mean? We look at today's environment. It's changing. The products you sell are changing. Your consumers' needs are changing, and a lot of that is being driven by a few different factors, such as national debt, such as increased taxes. We certainly avoided, thankfully, the fiscal cliff that everyone was very concerned about, but taxes in other areas still went up, payroll tax, for example. Government spending. The goal here is to cut spending, but until government really proves that that's going to happen, we have a problem on our hands, because really, as the national debt continues to grow And if we look here, going back to 2007, we can see that the national debt has grown on average at about $3.88 billion a day due to government spending. So we're spending more than we're bringing in. And obviously, those of you tuned into the news here over the last 6 months, we heard a lot about national debt. And if you look at that debt clock, it's about $15.816 trillion. But what's interesting about that is that's the reported debt that the government has to put out there by their accounting rules that are different from the way that you would have to run your business. The government doesn't have to report any of the unfunded liabilities they have out there for down the road. They only need to report the ones that are paid this year. So if they promise to build a bridge here in Minneapolis in 2015, that's going to cost X amount of money, that doesn't go on the debt that they report. So if we actually took a look at the government's overall unfunded liabilities, we'd be looking at somewhere around $76 trillion. So when you have a number that big, just like any business, if spending is high and revenue or taxes is low, what's the solution? Either lower spending or potentially, and at some point down the road, increase in taxes. And that's really where we see that life insurance and the FIUL can play a pivotal role, because it offers a unique combination of tax benefits like no other product. You have your tax-free death benefit first and foremost, the most effective wealth transfer strategy out there. Then you also have the tax-deferred cash accumulation inside of this indexed product, where you have that upside without the downside risk. And lastly, a part that we'll be talking quite a bit about today is the tax-free distribution on the back end via policy loans. Now, whether that's for college, for retirement, for business planning, there are all kinds of uses out there, and we'll get a little bit more into that later as to how people are utilizing these products for these three benefits. So taking a look specifically at the Life Pro Plus. When we look at the Life Pro Plus as an FIUL, you're not only providing, well, first and foremost, I should say, you are providing that death benefit. So if we look at any LIMRA study out there, it would say that Americans as a whole are drastically underinsured. So when you're talking to your clients, and maybe you're specifically into annuities or securities, whatever it might be, if you're not talking about life insurance, either someone else is, or your clients just maybe not getting a product that they potentially need for income replacement, mortgage coverage, college funding. What if something happens as they're funding a 529, as a traditional savings vehicle for their kids? What happens if something were to happen to them as the payer of that policy? That's where life insurance and a death benefit could come in to help. And don't forget about your small business owners. A lot of you working with that affluent market out there, many of those folks need business succession planning as well as individual insurance. But again, what we'll be talking a lot about today is not just that death benefit, but also the living advantages. So that cash value accumulation, those tax-free loans down the road, and using those to help supplement income either in retirement or for college or for whatever business plan they may need. A lot of times people focus on, how can I really diversify my client's portfolio in the growth phase? What about diversifying their distribution on the back end as well, and providing them with a way to have tax-free income in retirement as well? Now, before we get to the income and the loans, we need to grow that cash bucket. Now, one way Allianz and the Life Pro really separate ourselves is through the upside potential of our product. What you'll see here are some of the highest rates in the industry. So if you look at a couple of our index allocation options here, the blended index across the top is by far and away our most popular index, and annual point-to-point with the 16% cap. So you have that upside potential of 16% in a given year with a 0% floor. Right next to it, our monthly average, also very popular with the blended index. Now you have a truly uncapped strategy with unlimited upside potential. So we find that monthly average at the end of the year, and we apply that 150% participation rate. We have your usual suspects with the S&P and the NASDAQ as well, both in an annual and a monthly sum. But again, you can allocate to any or all of these options as you choose. With that blended index, though, if we took a look at a historical average, and we're going to be talking more about that in a minute, but if we backdated that 16% over the last 25 calendar years, you would have seen an average of about 8.85%. Now, these are just your standard options. We also have a group of select index allocation choices. What's great about the standard or the select is you can allocate to one or the other any given year. So you're either in the standard or you're the select, but what's great is you have the option to go back and forth. Now, what does the select give you? It gives you even higher upside potential. If you take a look there at that blended index, we've jumped from that 16% cap up to a 19% with 115% participation rate. What that means is that for a 1% charge on the client's funds allocated to the index, they get higher upside. Now, you are paying a 1% fee for that. This is just one option. So if you never want to use it and pay that fee, it's like it was never there, but you do have this choice. So if you have a client who's a little more savvy on the market and understands annual reset and coming in after a down market year and capitalizing on the bigger market rebound and getting more of that upside potential, going from 16 to 19, capturing 3% more for that 1% cost, this is a way you could allocate in any given year. And if you look to the right, that monthly average also jumps up from 150 to 180%. Again, just another set of options that are available for your client. We added a new option as well at the end of last year called with the annual floor with the same blended index. The trade-off here is you're able to offer your clients a 2% floor. So now in a down year, instead of getting that 0%, you're giving your client a 2%, even in a negative market. The trade-off for that is upside potential. Anytime you're adding guarantees to a product, you're trading off for potential. In this case, that 16% cap, as you can see by the first bullet there, goes to a 10%. So still a strong upside. 10% is still a great year, but you're also being more conservative, offering your clients that floor protection as well. One area that we've seen this being used more often is when we're illustrating loans down the road. And your client, maybe at 65, says, you know what, I want to be more conservative there. I've stopped paying in my premiums. I'm going to be pulling out funds. I want to make sure that I'm at least getting that 2% every year and trying to cover my cost of insurance every single year, even if the market is down. Now, upside potential isn't the only reason that the blended index has been our most popular by far. It's also because of the blended itself being a diversified allocation all-in-one. So if you see on your screen here, these are all pre-weighted options that are in the blended index. You have the Dow Jones at 35, the Barclays Bond at 35, the Eurostoxx 50 at 20%, and the Russell 2000 at 10. So you have a nice mix here of large cap, small cap, international, and a bond index all in one option. So when it comes to diversifying, you're really doing that with one allocation choice as opposed to mixing and moving all around. Now, really in developing our blended index, the goal here actuarially was really to create an index that would help diversify the risk, not only from an internal point of view at Allianz, but we also, as we've talked about, wanted to provide some access to a more exotic fund to your clients to help diversify their overall portfolio as well. This also lets us leverage our in-house dynamic hedging. For those of you unfamiliar with the way hedging works, that's how we're able to offer the caps and par rates that we do. Most companies are going out to an investment bank, excuse me, and buying these hedges. Now, obviously, anytime you go to another company to buy a hedge, you're paying a cost for that. So that's another cost that Allianz isn't going to have. We have a whole team on the third floor here that does our hedging in-house dynamically. And what I mean by dynamically is that we're adjusting that hedge and repricing our hedge every single day. So the more that we can do that, the more we can take out some of that risk, and we can pass on some of the savings here, not only from that investment bank, but also the savings in repricing these options to your client in the form of higher caps, in the form of buying higher grade bonds for our general portfolio. So really, the idea here is that we're able to offer an allocation that most carriers cannot. We've had this allocation out there for a while, and people have not been able to duplicate it simply because of the hedging experience we have here, not only with our life group, but also with the large size of options that we're buying through our annuity side. Real quickly here, need to go through some index disclosures. And now we can take a look at an FIUL here in action. So what we're going to do is look at a typical case. And a typical case typically is going to be somewhere between your 30s and your 50s. That's really the sweet spot on the product. Reason being is those folks usually meet 3 criteria. That is that A, they have a genuine need for the death benefit. B, they typically have the money to pay for this kind of a product. It is more expensive than your traditional term or lower cost ULs. And they also have time on their side. These are designed to be long-term products, not to be funded for just a couple of years and pull income right back out. These are designed to fund in over a period of time and then pull funds out maybe after 10 years. Again, that's not a hard rule. There's a lot of gray area in the way that we design these, but as a general rule, that's why the 30s to 50s is typically going to be the sweet spot on the product. So in this case, let's say we had a 40-year-old male, and we were going to look at a preferred non-tobacco. In this case, we're going to set it up with a $300,000 initial death benefit, and we're going to go ahead and max fund this policy. At the top there, you'll see the just about $12,000 a year paid in over the next 25 years to his retirement at age 65. Now, if we fast forward and look at the death benefit at age 65, because it's been increasing, the death benefit is now just under $1 million. The cash value at that point is just under $700. And if at that time we elected to turn on, stop paying a premium, and start pulling out policy loans, we could pull out roughly $53,000 every single year, income tax free, to help supplement his retirement. Now, obviously, there's more to it than just, hey, this is going to grow at 7 and we're going to pull these funds out. How are you going to do that? How are you going to grow the money? We talked about that with our blended index and averaging, in this case, 7%. But when it comes to pulling those funds out, Allianz really separates themselves again in that way. Now, if we take a look here, before we go into the policy loan side of it, let's take a look at historical averages. In that last example, we ran our policy at 7%. Now, what you'll see across the industry is that most or all carriers are using some sort of a historical calendar year basis to run their illustrations. So if you were to take, say, an annual point-to-point cap of 13% on an S&P in this case, and you ran that back 25 calendar years, you'd see an average of 7.22%. So if you took it out January 1st, ending December 31st, for 25 years, it would have averaged 7.22. But what's interesting is that with index products, they all are starting point sensitive. So moving that starting date from January 1 to 4/1 of the same year, so if we just move to the right one spot there, that same 25-year block, but just moving a couple of months, would have given you an average of 8.2%. So really what I'm trying to illustrate here is that when it comes to designing these IUL products, there's really a lot of gamesmanship that goes into it. Moving the starting date just slightly can give you totally different historical results, and you're the ones out there selling it. You're the ones standing behind these numbers. Where's the credibility in just saying, hey, this averaged 7% over 25 years when, I could come out and say, well, it averaged 8 if I just move it a month. So what we did is to get around some of that is we came out with a new backcasting tool. And what the backcasting tool does is it allows you to increase your sample size on historical backcasting dramatically. So now instead of going back to one policy anniversary date and saying, hey, with this cap we would have averaged 7%, now what we're going to do is go back to 1/1 of 87. We're going to assume we buy a policy every single day from that point on and look at 5, 10, and 20-year rolling periods. And the goal here is that we want to see how often would we have hit the illustrated rates that we're assuming based on that cap over all these different policy start dates. So if we looked at the 20-year, for example, which we will in a moment, instead of having one policy start date, you now have 1,800 policy start dates that we're looking at, and you're able to say, over that period of time, X% of these policies would have hit 7% or 8%, assuming this cap. So what this is designed to do is to try to level the playing field. So typically when agents are running these illustrations side by side, they're saying, hey, let's run them both at 7%. Well, what Allianz is saying is that there's a big difference between a blended index at a 16% cap and an S&P at a 13. How would those two compare? if we looked at them over that period of time, who would have achieved that apples to apples 8% more often, the 16 blended or the S&P at 13? So what I'm going to do here is I'm going to quickly jump over to our illustration software. What you're able to do when you get into our website is run this backcasting tool. So you can come in, plug in any one of our allocation choices you see here. So let's say annual point-to-point blended at 100% with a 16% cap, 0% floor, and 100% participation rate. We want to know how often could we have averaged 8% over that time period. When you hit reports, what you'll get is a consumer report that looks like this. And a couple of things I want to point out. If we look at, again, 5, 10, and 20-year rolling periods, what was the worst 20-year period in that block? Remember, we're talking about roughly 1,800 policies over that time period. The worst average, considering that cap, was 7.53%. And if we slide over here, what happened 75% of the time? So a vast majority of the time, those policies were averaging 8.39. Half of them averaged almost 9%. And if we look down here, how often would we hit that illustrated rate of 8% that you're going to be showing that you might be showing your client? Again, I'm not saying 8% is the number. This is just an example. But how often would you hit 8%? If we look down at that 20-year, 95% of those policies averaged the 8% that we're assuming in our illustration. Again, we're not saying run your quotes at 8%, but what this is going to do is give you a way to really level that playing field and separate, say, the blended index here from others that are out there. So now if we went back and you said, well, how would that compare to if we wanted to run an S&P with, say, a 13% cap? You could come in, plug those numbers in, go to your reports, and if we take a look here at your 20-year worst historical average, 6.68, almost a full percentage lower as a historical average. And if we look at the upside potential, 75% of them did 7.5, again, about a full percent lower, and half of them did 7.76. So really what you're looking at is a full percentage difference there on some of those average returns. And we'll talk in a minute here about how big a difference that can make. And if we look down at this number, which is one of the most telling, at the 20-year, how often would that S&P at a 13% cap have hit the 8% average? Only 31% of the time. If we remember, the blended index with the 16 would have averaged that 95% of the time. So when you're running these illustrations, keep that in mind. Running 8% with one and 8% with another is not necessarily apples to apples. It's important to look a little bit deeper and find out who's more likely to achieve these illustrations that you're presenting to your client that you're standing behind. Now, I mentioned that 1% difference can make, 1% change, that can be a huge difference. When we're talking about compounding over 20, 25 years, not only in the growth phase, but also in the loan phase, we can be talking 1% change there, can be talking about 20% in the form of loans, a 20% difference with a 1% change. So I'm going to jump back over to the PowerPoint here. And what I want to look at next is going to be not only how we build it up, but how Allianz has an advantage when it comes to pulling the funds out. Typically, you have a couple different loan options when it comes to borrowing money. And this is true with most carriers. You have what's called a participating and a fixed loan. Now, with Allianz, we have a fixed participating loan. What that means is that we're guaranteeing a loan rate in the future of 5.3%. That's guaranteed for the life of the contract. So when you're selling that client today, and he's 40 years old, and you're selling him, hey, down the road when you're 65, we're going to design this for you to pull loans out, you can guarantee him a loan rate of 5.3%. What other loan options are out there anywhere where you can be guaranteed a loan rate in the future? So really what you've done here is you've added some certainty to an assumption product. You know, see below there, I don't want to breeze over it, but you do also have your fixed loans in the first 10 years that would cost you 2%, and in the years 11 and beyond, it would be a wash loan or a 0% cost. But what I want to focus on for a second is that participating loan. So down the road, we're assuming that you borrow at 5.3, but what you do here is you continue to participate in the index with the rest of your cash value. So even while you're loaning money, that money stays in the index and earns index gains. So if you borrow at 5.3 and you earn 7.3 in the index, you just had a 2% positive arbitrage on your money. So not only did it not cost you anything, you actually made money on it. Now, this isn't a new or exclusive to Allianz to have a participating loan, but what does differentiate us is that ours is fixed and locked at 5.3. Typically what you see in the industry is a variable participating loan. So it's going to be based on that Moody's corporate bond yield number. When we look historically, we can see that number ranging all the way back to 91, over 9%, currently at historic lows. So you might be out there seeing other carriers representing 4% or low fives or even lower as their variable loan rate. But just as it's by definition, that loan rate can vary. So instead of having a locked-in 5.3, you don't know what your client's going to be borrowing that money out 20 years. You don't know what that loan rate will be. I mentioned in our growth assumption that a 1% difference could mean a 20% difference in loan amount. Well, that same holds true if that 1% difference was in your loan rate. So if you're designing your illustration with a 5% variable loan rate, but when they get out down the road 25 years and they borrow at 6, the same would hold true. That loan amount that you showed of $53,000 might be reduced by 20% based on the miscalculation there with that variable loan rate. And if we look here at the historical on that Moody's, if we go back 10 years, over 6%, 20 years, 6.9, and if we go back 25 years, almost 7.5%. So what's interesting is the carriers that offer the variable loan rate are illustrating growth based on 25-year historical assumptions, but they're using current variable loan interest rates. Your illustration would look drastically different if you were running a loan rate closer to 7.5 as opposed to where they are now, around 5 or under. So again, a huge differentiator when it comes to Allianz is being able to not only build that cash value up higher than most with more probability of achieving those assumptions, but also being able to offer them a fixed guaranteed loan rate down the road, whether that's for college, whether that's for retirement. You know that's locked in at the 5.3%. Allianz also added some new riders here. Recently, last year, we came out with a new premium deposit fund rider. Now, for those of you who are maybe annuity producers, you're used to that single premium, this really might be of interest to you. What the premium deposit fund rider does is it allows you to use a single lump sum payment into the Life Pro without creating a modified endowment contract. For those of you unfamiliar with modified endowment, what that means is that you're putting in a lump sum premium and you're creating a MEC policy and basically changing all those tax benefits on the living side to look just like an annuity. So if you use that lump sum, traditionally what that would mean is that now you still have a tax-free death benefit, but when you want to go access the funds, the same rules apply that apply to annuities. Pre-59.5 penalties, and we're looking at last in, first out, and those gains are taxable. So typically that's why you see life insurance policies designed with a minimum of maybe a 5-pay or 7-pay, trying to get as much money as fast as possible, but still under the IRS guidelines. This PDF account can help you do that. You submit a lump sum today, it goes into the premium deposit fund rider, and then we pull those funds out over a period of 3 to 10 years to max fund the life insurance policy and keep it in non-MEC status. Now, when doing so, you're putting that $100,000 in, let's say, as we pull those funds out, it's not earning interest. Instead, we're crediting a 2.25% premium discount rate. We take out a discount of 2.25% on the planned premium that goes into the Life Pro every single year, and that compounds year after year. So the longer that we're paying it in there, the more that Allianz is going to be contributing into the policy. Let me show you an example of how that would work. So in this illustration here, you can see clients making a lump sum into the PDF. We're going to assume those funds come out over a period of years and go into the life policy. Here's how that would look with a numerical example. If we had $100,000 and you're dropping that into the premium deposit fund, what we establish is a planned annual premium. In this case, we'll assume that's the max non-MEC premium of $17,607. So year one, the money hasn't been in the rider long enough to earn that discount. So we're pulling the full $17,607 from the PDF, which means you have a remaining PDF value of about $82,000. Now when we go to year two, the 17,607 is still going to be our planned premium contribution into the Life Pro, but this time we're going to discount that premium by 2.25%, which means we're only pulling $17,220 from your client's fund, and Allianz, if you see there in the light blue, is adding $387. So your client's PDF remaining value is still $65,173. Year 3, that happens again. 17,607 is still our planned premium, but now your clients, we're pulling only $16,841 of your client's money out, and Allianz is adding in $766. So your remaining PDF value is $48,332. Now, what's great about the premium deposit fund is not only are you getting that 2.25% discount on your money, but it's completely liquid, which means, let's say here after year 3, your client has an emergency come up or just like those funds back, they have full access to that PDF value of $48,332 at that time. There's no surrender, there's no chargeback, anything like that. They have full access to those funds. They're not locked in like you might be on another kind of immediate annuity type payout. So let's say that you stuck with this plan. As you can see here, the contribution from Allianz continues to go up every single year as that discount compounds over those years. And in this case, we take a look at his $100,000 premium contribution turned into a total discounted amount of $5,644 contributed by Allianz. So that $100,000 turned into $105,644 in premium contributions. So ultimately, this is a way to simplify the process for you and your client using a lump sum premium and still maintaining all the tax benefits that life insurance provides.
Nate, how do the commissions work for this particular rider?
Oh, good question. There are no commissions on the premium deposit fund rider itself. You're still paid on the target premium of the life policy itself. So the target may go up a little bit as that planned premium increases, but there's no specific commission option paid out on that. But like I said, if you were to say compare that to using a SPIA instead, I'm going to use a SPIA to fund that, get the smallest percentage really of commission from that. I think if you do the math, I believe it's right around $2,500 or $3,000 in commissions there for that $100,000. That translates, if we look at difference between 2.25% on the PDF and the half point you might get on the SPIA as far as to your client, that $2,500 in commission really translates for a 40-year-old male looking at income at retirement into more than $2,500 or $3,000 every single year in policy loans that they're able to pull out. So for your client's benefit, that 2.25% certainly offers them a lot more down the road in the way of cash value and ultimately loans. Another rider that we have on the Life Pro Plus that's unique is called the Inflation Protection Rider. Similar to some of the income riders that you see out there, or the increasing income story, that's what we're providing here with the Inflation Protection Rider. Down the road, we're taking a look at this rider. This rider is automatically included on the policy, and down the road, you have the option of turning the rider on. And what this will do for you in a high inflation environment is give you credits based on that consumer price index for urban areas. So every single year, let's say we're in a 5% inflation environment, we would start crediting your protected amount for the inflation rider, that additional 5%, and increase your income every single year. So really what you're doing is protecting your purchasing power, adding those additional index credits, and building your overall buying power. So again, totally optional. It's on there in a high inflation environment. It absolutely would make sense to turn it on. You'd be looking at over a 20-year span, potentially doubling your loan value from the initial amount at 65 through 85 in, say, a 5% environment. If we are not in a high inflation environment, you never turn it on. It was like it was never there. But again, just another option that you do have with the Life Pro Plus. Another rider or credit program that we implemented with the Life Pro, the Lifestyle Credits, really just another way to increase your client's risk class rating. So we're looking at favorable lifestyle factors like routine medical checkups, family history, are they doing preventative screenings, and really we're able to maybe take that standard and go to the preferred, or one risk class better than where they maybe would have been, just based on living a healthy lifestyle. And what's great is this is not something you have to go and reapply for every single year. it's automatically done on the front end by our underwriters. So again, just wanted to touch base on a couple of the key benefits that Allianz provides. Number one being that upside potential of our index options, the experience and expertise we have in pricing and dynamically hedging those index options. And number three, the way that we're able to offer your clients a guarantee in an assumption product by giving them that 5.3% guaranteed loan rate that you can count on down the road when they go to access this money at retirement or for college. I'll go ahead and I'll turn it back over to Lori here if we have any questions before I move on.
Great. We've got a couple of questions, but to be honest with you, they are either really complex in nature or difficult for me to really fully understand what the agent is asking. So to those of you who have questions, and Kyle, I see you've got a couple in particular, and Fred and Irving, we'll get back with you and answer those questions to you on an individual basis. Because I do have some concerns about being able to answer them accurately based on the cryptic question that you typed in. So we will get back to you on that, but probably offline. One of the questions that we did have here related to having some materials available to better explain this process. And Nate, you do have something available at Allianz, right?
We do. Specifically on this one, we have our most popular kit called Success with FIUL. And what that's really going to cover is all the materials we went through today. So there's great consumer-approved materials in there talking about how does FIUL work, what are some of the common questions, how does hedging work, how does indexing work, all written for your clients, so it's easy to understand, easy for them to follow as you're presenting this product. And it's not so much product specific as it is concept, so they're able to grasp what we're trying to do, and it's not just you pushing product. So a couple of great pieces in there, and I know Insurance Network has those available if you give them a call. We also have a couple other kits for those of you who are maybe focusing on the college market or on the small business market. We have some outstanding marketing kits for those areas specifically, and how FIUL can benefit you in college funding or for planning for small businesses.
One thing I would say about Allianz is you've certainly spent a tremendous amount of time, money, and effort on some very specific consumer kits for these agents. And if you haven't had a chance to look at those, or you are curious about what's out there, please contact our team, or if you're contracted with Allianz, certainly you're able to contact them directly, because I don't think anybody's doing a better job than you are when it comes to those advanced market kits. Now, for those of you who are on the call today and you'd like to have that success with FIUL, sorry that I don't have the phone number on the screen, but most of you know it. I'll give it to you again. If you call our office, and the 800 number is 1-800-456-7999. It's 1-800-456-7999, or locally 208-344-1143. Ask for somebody to help you out with the Success in FIUL kit, and we will certainly get that out to you. Hey, did you have any final comments, or? Well, nope, we've got these guys at 40 minutes, so.
Yeah, I know we'd like to get them out and get them back in the field. I don't want to take up too much of your time, so I would strongly encourage you, though, to give Insurance Network a call, get your hands on this kit. We've had a lot of success with our top producing agents and getting it in the hands of their clients, so certainly give them a call and get that kit.
And certainly if you need an illustration or anything else or additional questions about the material presented today, we've got a team of people ready to help you. If you're already working with somebody on the life and annuity team, please just call in and give them a call. If you are not, call in, and our receptionist will be glad to get you with somebody. So again, thank you. I know your time is money, and I appreciate you spending it with us today.